So today we are going to start from chapter 4, taxation of business and investment income. That's a company income tax. This company income tax is one of the most important aspects of our syllabus. That is to say, we cannot but joke with this chapter because it's focused more on the aspect that I can do as a question. In most cases, this aspect always forms our number one question. For past two days now, the company income tax has been almost our number one question in the exam. So let's see what the chapter is all about, then how we're going to address it. Let's start from page 50 of our part. I think that will be chapter 4, page 49 of our part. Our style will be the same. We go through our part page by page and we'll discuss it. As I'm reading, you look at the line by line and we'll discuss. Then from there, after that, we now look at we bring in questions from our question bank. Then we solve it together in that discussion. So let's start from that chapter 4, page 59 for my manual. Taxation of business and investment income, that is company income tax. The purpose of the study is given there. That is a 4.0 purpose. I'm not going to read the purpose, but let me go straight to the legal framework for imposition of taxation now. The legal framework of taxation. This is the authority that enables the federal government to impose and collect tax from the citizen of Federal Republic of Nigeria. They are classified as follows. Now, when we say legal framework, those authority that impose tax on citizens in Nigeria. 1. The Constitution of the Federal Republic of Nigeria provide for the exclusive and the concurrent list. The list is reserved for the federal government and the exclusive right to provide legislation on the taxation of income, profit, and capital gain tax. Now, what I say is, Constitution is one of the legal constitutional framework that a mandate of collecting tax in Nigeria. Now, tax and levies, approval list for collection act. This tax and levy approval list, this is a list that give the taxing right of individual act of government, that is, the states, the federal, and the local government. This tax list tell us the tax that must be collected by the states, the tax that must be collected by the local government, and what by the federal government. For the federal government now, this relates to the company income tax. It is the company, it is the federal government, that is Federal Revenue Services, that collects company income tax. Withholding tax on companies resident of FCT and the Abuja non-resident. Now, this FCT now has been removed. I don't know why they have not changed up to now. Unlike before, it is federal government that collect the tax of residents of Abuja, but now they have their own board of internal revenue in the FCT, the FCT board of internal revenue that collect that one. Then for non-residents, yes. Who is a non-resident again? From our personal rate of tax, who is a non-resident?
Non-resident. The person that has not like 183 days.
Okay. So what happened? Oh yeah. Let's talk about that. We are in tax class.
The person that has not spent up to 183 days in Nigeria.
Okay. That's a non-resident,
yes.
Okay, you are technically correct, but in standard way, a non-resident individual is a person who does not domicile in Nigeria. Or a person who stays in Nigeria for less than 183 days. Can you see the point now? A non-resident individual is a person who does not domicile in Nigeria. He does not even live in Nigeria at all. Or who stay in Nigeria for less than 180 days. And don't forget in tax law, either you are a resident or you are not a resident, you pay tax in Nigeria, right? So in that case, that person pay tax to federal inland revenue, not to the state. Number 3, petroleum property tax. Also go to company, to federal government, value tax, tertiary education tax, capital gain tax, that is company and non-resident. That is there because individual to pay capital gain tax, which is collected by state. But once you are a company and once you are non-resident, you pay to federal government. Then stamp duties on companies and non-resident. Then personal income tax, PIT, in respect of members of armed force, police force, and staff of foreign affairs and the non-resident individual. All these category of people, they pay their tax to who? To the federal inland. That is taxing right of the federal inland service. Now, the following legislative guide the position of tax in Nigeria. These are the acts that govern tax payment in Nigeria. 1. Petroleum Profit Tax Act. That one is a guide people that engage in the oil and gas, that the sort of crude oils. Number 2, company income tax that relates to the oil companies. Company income tax amended 2007, the Capital Gains Tax Act 2004, the Tax Education Act 2004, the Personal Income Tax Act 2004 as amended in 2011. Don't forget, all these acts have been amended in 2020 by financial act, financial bill also. The amount of that tax also, stamp duty also, Federal Inland Revenue Services Establishment Act 2007, and the other subsidiary legislation, then income tax, transfer pricing regulation in 2018. So all these regulatory acts govern tax collection in Nigeria. So let's look at the background to company income tax. The background history of company income tax. Let's quickly run through this background for better elite understanding, that you just know the brief history of tax company income tax in Nigeria. The authority to charge limited liability company operating in Nigeria to tax is contained in the Company Income Tax Act as amended. The procedure are contained also in the same act and subsidiary legislation. For this purpose, distinction is made between Nigeria and non-Nigerian company. For the purpose of assessing company tax in Nigeria, other company income tax, they always make a decision between Nigerian company and the non-Nigerian company. These two information is very important because you must be able to identify a Nigerian company and we need to identify a non-Nigerian company. Now, the procedure I've said that. Now the question is, what is a Nigerian company, or which company can we categorize to become a Nigerian company? Are we together, please? Are we together? Now let's look at it now. For the purpose of this decision is made between a Nigerian company and a non-Nigerian company. A Nigerian company is defined as one incorporated under Company and Allied Matter Act in Nigeria. That is, you are a Nigerian company if you are incorporated based on the Nigerian canon. Now, that means for every company, before you can call a Nigerian company, you must be registered in where? In Nigeria through what? CAC, Corporate Affairs Commission. Then once you register as a Corporate Affairs Commission, then you are a Nigerian company. You know the it is not there. So that is Nigerian company. But a non-Nigerian company, let me go back to that page, to that line. A foreign company that is non-Nigerian company is defined as any company or corporation established by or under any law enforced in any other territory or country outside Nigeria. So you are a non-Nigerian company if you are registered in a law that is not in a Nigerian law, that is not a canon. That means you are registered in another country law, then and you are operating in Nigeria, then you are a non-Nigerian. The question now is this: there are some companies, they are Nigerian company, they operate in Nigeria, right? I mean, why some companies they are not Nigerian company and yet they also what? They operate in Nigeria. Does it mean that you pay tax because they are not Nigerian? No. In Nigeria tax law, payment of tax in Nigeria does not distinguish between a Nigerian company or non-Nigerian company. Provided that you are operating in Nigeria, you are subject to what? To pay tax in Nigeria. I want to say page. Now let's look at it now. The income of a Nigerian company is access to tax. It's accessible to Nigerian tax irrespective of where it is derived, or notwithstanding that it has not been brought into or received in Nigeria. Whereas the income, now they are going to tell you that if you are a Nigerian company, look at that statement, if you are a Nigerian company, all your income, your total income, that is irrespective of where you make this income from. Whether you are a Nigerian company such a company is acceptable to tax under Nigerian tax law. I want to say please. Now, what I'm saying is that you can be a Nigerian company, you are registered in Nigeria, but you have some business outside Nigeria, abi? And once those business make income over there, definitely you bring the money down to Nigeria, right, abi? Then such income is what? Is subject to tax. That's why we said for every Nigerian company, you are access to tax on income either it's approved in Nigeria or derived in Nigeria or brought into Nigeria. It will be what? It will be assessed to tax in Nigeria. That's for Nigerian company. But if you are a non-Nigerian company, then it's only the portion of income that is derived in Nigeria that will be accessible to tax. I want to say it now. Let's do that again now. The income of a Nigerian company is accessible to tax irrespective of where it was derived, and notwithstanding that it has not been brought into or received in Nigeria, whereas the income of a non-Nigerian company shall be subject to tax only to the extent to which such income is attributable to the company operation where in Nigeria. So it is only the income that can be attributable to the operation in Nigeria that will be what? That will be accessible to tax here in Nigeria. Hope you are getting the logic now. So what I'm trying to say is this: the fact that you are a Nigerian company or Nigerian company does not, you must what? You have to pay tax to people. Just that the extent to which we tax them is what? Is different from each other. This one is all your income. Either you get it from Nigeria or you what? You brought it to Nigeria. It will be what? You tax in Nigeria. Whereas for a non-Nigerian company, it's only the profit in your income that can be attributable to Nigeria operation that will what? That will be taxable here in Nigeria. I want to say it now. Let's go for a little bit now. Now, the procedure for this class of companies shall be considered in later chapter dealing with what? International. That when you get to international, they are not residents of the thing or international taxation, they will get down better. Then, identification of a company. Now, when it comes to each of company in Nigeria, there's a way we identify companies. And one of the means of identification of tax in Nigeria is so-called TIAB, tax identification number. Now, in accordance with Section 8 of Company Income Tax Act, the incorporation number of a company and the tax identification number team. What is the incorporation number? That when you register with CAC will give you RC number. They will give you like almost digit number like that. They will give you. As you are getting this number, you also go to tax. Go and get your own call T number. That was like almost a 11-digit number. It was 40. So once you give it, so those two number is your identity as far as company is concerned in Nigeria. Once you have your RC number and you have your T number, that's identity in the tax law. So the T number generated by the Federal Inland Services shall serve as an identification number of the company and shall be displayed by the company on all business transactions with other companies and individuals, and on every document, statement, return, auditor account, and correspondent with the revenue authority, including the Nigeria Customs Services, ministries, and all government agencies. Can you see now? That thing, even if you don't mention your name, the moment you provide your team, that's your identity. You can easily get your identity as they like. That is like now, trade or a business. Trade or a business. Now, for every companies, you engage in a particular business, right, Abi? But the question is, what constitutes a trade? What constitutes a trade? Trade or a business? Companies are normally formed to carry out a particular activities, which will be specified in the objective clause. No, when you want to register with TAC, in your memorandum of association or article, there will be an objective clause. That is the major reason why the company is being established. So you have to state your objective, the reason why you want to start the business, you want to incorporate the business, you have to state it there. So in your objective clause, you have to state it there. Therefore, in determining what constitutes a trade or business of a company, it is necessary to refer to what? To the objective clause. If you ask, okay, what are you doing as a business or for trade, then you have to fix your objective clause. It's objective clause that will state what you want to be doing in the year. So then, to ascertain the activities that the company was registered to carry out. The carrying of such activities will definitely constitute trade or business, and the income therefore will be subject to company taxation in accordance with the provision of the act. So it is your activities, any income that come from the activities, that is the income that you will be taxed on every year or as may be. Now, the carrying out of such activities will definitely constitute a trade or business, and the income therefore will be subject to company taxation in accordance with the provision of the act. Thus, a trade or business will include manufacturing and any other activities being carried on in the portion of the goals for which the company was possibly actively to be kept in its business. It is only reasonable to conclude that the income from such activities constitute chargeable transaction and will therefore be what? Be taxed. What I say is, all those activities that you have stated in your objective clause, it is what is going to constitute the income that will be what? Will be subject to tax on. But do you agree with me that when a company carry out a transaction that is not objective clause, is it legal? Is it legal? The activity that is found in your objective clause, hello, in your objective clause now, there is no sense of petrol, oil and gas is not there, and you now go ahead and open filling station. Is that allowed in law? What do we call this in law? Ultra is a criminal offense. It's not allowed. So, but sometimes some people do that. But there's a way we normally capture it. When you are registered as a lawyer, when you want to help you to register, in the objective clause, you put it there. Engage in all merchandise. That will cover everything. So it's just a few. What am I saying? It is not activities that is the objective clause. So any moment you engage in those activities and it's bringing income to you, it becomes what? It will become taxable in Nigeria. So now, but look at, except if they relate to capital items, that is, except those activities relate to capital items, God, capital items are not subject to company income tax. They are subject to what? Capital gain tax. Except they relate to capital items or are specifically exempted by the provision of the act, because there are some income specifically they are exempted from tax in Nigeria. Hello, I would say that not all income can be taxable in Nigeria. There are some income that are what? Specifically exempted from tax. So neither the absence of profit-making motive, in particular transaction, nor the fact that they are isolated and not related to the company normally business could prevent the income from some transaction from being subject to the company's taxation. Now, basis of assessing company to income, yes. This is one of the area that we must ensure that we understand best. Because if you understand this aspect of tax law, there is no how you need to tackle the company income tax in Nigeria. So let's look at this. Basis of assessing company to tax. The basis of assessing company to tax. Now, in Nigeria tax law today, if you want to assess company to tax, there must be if I remember last week we were talking about the kind of tax. And people say the simplicity, and this is to understand. So the way, the manner at which you will be assessing company to tax. Let's see the base on that. Let's go on to it now. Basis period. Now, the first you have to understand is what we call the basis period. Now, before I talk about this basic period, let me mention this. Accounting period. Accounting period. Now, there is a slight difference between accounting period and basic period. Every company prepare financial statements for a particular period. Some companies use December as their accounting year end. That is their year of anniversary. So if a company is using 31st December as the accounting year end, that means you have to prepare financial statement that cover 12 months that will end when? December. So let's assume we are dealing with 2019. That accounting period will be from 1/1 2019 to 31 December 2019. So when we say accounting period, they are the period in which the financial statement is prepared for. It could be that sometimes from December can use, if you don't use December, you use September. If they use September, that will be for when? If they use September, that will be for when? That will be for October 2019 to when now? 31st 9 2020 that will be the 12 months. So it depends. So the accounting period, those are the period in which the financial statement is prepared for. But when we now come to basic period, because we have said this, you cannot be talking about basic period without referring to accounting period. Are we together? Because in tax law, there's a way we pay our tax. In most cases now, we pay our tax now on preceding year basis. That is, if you are in 2023 now, any tax that you are paying this year, you are paying for the tax from last year. And then now paying the preceding year basis now. If you are talking about the basic period of 2020 now, so basic period of 2020 is the accounting period in relation to a particular year of assessment. If 2023 is your year of assessment now, the accounting period that will be attached to this year of assessment now will have to be basic period. So a basic period is the accounting period in relation to a particular year of assessment. Am I communicating now? So let me just comment again. Basic period. This is defined period of time in the life of a company. It is an accounting period which is related to any particular assessment year. If your assessment year is 2023, the question is, what will be the basic period? It is the period for last year that you are not paying tax this year. Are we together now? That's what companies now. All chargeable profits or income falling with this period shall be assessed to tax as may be appropriate now. All chargeable income that falls in this period, hello, who's like this? All income that falls in this period now will not be assessed to tax based on that period. In this now, what will be our year? 2020, abi? If you are using January to December. So all income that fall in this period, that will be base period will be taxable when in 2020 year of assessment. I will tell now. Now let me do that now. There's a year of assessment and there's the accounting year. Which better? There's a what? Year of assessment, there will be accounting year. Accounting year is the year that you are reporting your financial statement. Am I talking now? The accounting year for this one should be what? Accounting year for this one should be what? 2019. That's the accounting year. Right now, you are reporting for 2019. That's your accounting year. But the year of assessment is the year in which this tax will be paid. So, the year of assessment is the year in which you are being assessed to tax. But accounting year is the year in which the assessment is being reported to the owner or to the shareholder or anyone you are talking about. So, this accounting year will be the year of assessment. So, based on this, I've defined 3 things now. I've defined year of assessment, accounting year, basic period, and what? Accounting period. I mean, accounting period is just the period in which financial statement is being reported for. While accounting year is the year in which you are reporting for, but year of assessment is the year in which you are being assessed to tax. While your basic period is the accounting period in relation to a particular year of assessment. I want to say page, please. Just say I want to say page. How you want to say page? Those people will still before that place. Now, so relevant definition. Let's try to look at the relevant definition one after the other. 1, basis period. I've defined it already. This is defined as the basis upon which the taxability of a company will be what? Will be computed. So it's based on the income here. All the income that you have here, this is where you have to base the tax on. That's the basis period there. Tax year or year of assessment. Tax year or year of assessment. What does that mean? This is a government financial or fiscal year which runs from January and end when? December. It is also described as the income tax year. A company according to a company accounting year will be related to the government tax year in which the operating result of such company is to be what? Is to be assessed to tax. In a simple and easier way, your assessment is the year in which the company is what? Is assessed to tax. In a simple language, is the year in which the company is what? Is assessed to tax by tax authority. That is a year of assessment. Then, preceding year basis. We have to understand about this. When we say preceding year basis now, is the accounting period that precede, or let me say, it's the accounting year that precede the year of assessment. For example, now, if you have 2019 now, this is the year that precede your what? 2020, that's the preceding year. So in most cases, when you are 2020, you are actually paying the tax for which period? For 2019 accounting period. I will get that preceding year. Let me read that again. This is the basic period that ended before the beginning of the government fiscal year or tax year. It means that the basic period of the taxpayer for the relevant tax year ends the year before the tax year. Now, if look at this period, your tax year start from January 2020, abi? The period that end before this date, that will be preceding year. Please, you have to be careful. If your accounting year does not relate like this, you can buy this one is sensitive now. January to December, abi? Unlike this one that I run from January October, abi? October to September. Now, in this case now, you can easily say that the year of assessment of this one is 2020, abi? But in this case now, your year of assessment, since this one ends in September, your year of assessment you cannot fall in 2020 again. You have to fall when? 2021. Once you must also come to your mind is that whenever you are talking about preceding year basis, in your date, it is your date. None of these dates you will pay tax in that year. You will pay tax in a year that comes after this. Hello? Now look at this 2019 abi, this 2020 abi. You cannot pay tax at the end of these 2 days. You pay in the year that next to finish what? 2021. So this one called preceding year basis. If I formulate another one now, if I said you start from March 2018, you end when? February, 20th of February 2019. What will be the year of assessment now for this basis? 2020. Preceding year basis. You must understand this. When we mention preceding year basis, in most cases, in your date, in your basic period, none of these dates you are going to pay tax. So it will be a year after your end period. It could be 2020. Depends on what date falls. I will together. What if it's 1/1/2018 to 31st December 2018? When are we going to pay the tax? That will be the year of you must understand what preceding. This is the accounting period that ends before your year of assessment. So let's go to the next slide now. Actual year basis. Now, this actual year basis, this is the basic period that coincides with the government fiscal year running from when to when? January to December. There's some basis whereby you pay tax. Your accounting period will be 1/1/2019, ends when? 31st December 2019. This is actual year basis. You have to pay the tax when? In 2019. This basis is no more common now because of the Finance Act. Based on Finance Act, all companies must be what? Must be assessed to tax on preceding year basis. Are we together now? So in most cases now, it's hardly you see this basis now in our tax law in Nigeria. Everything now is now based on preceding year basis. Okay, let's go straight to normal basis now. A normal basic period is made up of 12 months. It will start immediately the previous tax year basic period ends. Normal basis is like always like this. Once if your like this one now, it will be like now 1/1/2019 to 31st December 2019. Automatically, the next one will start from where this one ends. That will be what? 1/1/2020 to what? 31st December 2020. So you want to continue like that. That will be as a normal This is a period. Okay, then abnormal basic period. Yes, this one always occur when the company is just commencing business, or when the company change the accounting date, or when the company is about to work to cease. So in most cases, that we will see abnormal. Sometimes it will run like for like 16 months. It will run for like a period less than the 12 months. Abnormal basis. Abnormal basic period. It is either less than or more than 12 months. It may not start immediately. The period starts year end, basic period. There are 3 risk situations in task leading to abnormal basic period. The conditions that can result of abnormal basic period. Normal basic, everything will be in line. As one is ending, another is continuing. As one is ending, another is, that's normal. But abnormal basis is like it will not be regular, it will not be normal like this. It could be lower than 12 months, more than 12 months, or sometimes as this one is ending. The as one is ending 7 now I can start like March. So it will follow. That's what called abnormal. What causes it? One, where there's a commencement of a